Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's get right into it. Welcome to this explainer. Today, I'm putting on my equity research analyst hat to break down a company caught right in the middle of a massive, high-stakes corporate metamorphosis. We are analyzing BioNTech. You definitely know them as the pandemic darling, the co-creator of that historic COVID-19 mRNA vaccine. But right now, they are standing directly between two completely distinct eras, their pandemic past and a highly ambitious oncology future. We're going to strip away the hype and look at the raw financial reality.
So, it's the multi-billion-dollar question. What exactly happens to a biotech giant when the pandemic officially ends and that massive primary revenue stream just dries up? Today, we're unpacking this fascinating corporate transformation, and we are completely bypassing the media spin. We're acting as investigative journalists of financial statements today, pulling data directly from their latest 2026 earnings reports, SEC filings, and hidden footnotes to see exactly how they're navigating this transition.
Here is our agenda for the breakdown. 1. The post-COVID reality. 2. Pivoting to oncology. 3. Trimming the fat. 4. Leadership and spin-offs. And 5. The valuation paradox. Let's dive in.
Section 1. The post-COVID reality.
Look, the hard numbers absolutely do not lie. Q2 2026 revenue came in at 105.6 million euros. That is a steep 59.5% drop from the 260.8 million euros reported in the exact same quarter of the previous year. What's driving this cratering? Simply put, softer global demand for COVID-19 vaccines. The world has moved on, and BioNTech's income statement is feeling the immediate, painful impact.
And you know, this isn't just a single bad quarter. Their official Q1 release showed that this revenue slide was well underway earlier in the year, starting with an initial 35% year-over-year drop. The trend line is crystal clear here. The pandemic-era windfall is firmly in the rearview mirror.
Because of this ongoing trend, management was basically forced into a corner. They had to revise their full-year 2026 revenue guidance downwards, projecting between 1.6 and 1.9 billion euros. Beyond just lower demand, they cited a very specific headwind: existing vaccine inventory in Germany cannibalizing expected new sales. Now, as an analyst, I ignore the headline revenue beats and EPS misses. Let's look at the 7 media blackout red flags I found buried in these filings. Decelerating inventory turnover. The media ignores this because, honestly, supply chain math is way too boring for a TV soundbite. Looming goodwill impairment on legacy assets. It's too accounting heavy for retail investors to care about. Negative FCF conversion looming. Predicting capital expenditures outpacing declining net income requires multi-year forecasting that headlines hate. Rising days sales outstanding from international distributors. Cash collection delays just don't fit the shiny biotech innovator narrative. Tax rate normalization. Nobody clicks on articles about deferred tax accounting eating into the bottom line. Shrinking R&D efficiency per clinical asset. It's incredibly hard to quantify for the general public without a PhD in pharmacology. Geographic revenue concentration risks. The German inventory overhang is simply too regionally specific for major U.S. financial media to cover.
Section 2. Pivoting to oncology. Let's look at the bright side. The absolutely crucial point here is 16.6 billion euros. Despite plummeting quarterly revenues, BioNTech is sitting on a staggering 16.6 billion euro war chest of cash and investments. This financial muscle acts as a massive safety net. And just like we found red flags, digging into the footnotes reveals 7 overlooked green flags. Deferred revenue dynamics stabilizing. Revenue recognition schedules are dense, so analysts completely overlook the stabilization happening under the hood. The 16.6B cash pile acting as an ultimate floor. Pure cash safety isn't as sexy to report on as hypergrowth. Decreasing supplier concentration for mRNA lipid nanoparticles. Supply chain stabilization is incredibly unglamorous to the media. High patent citation index in next-gen oncology. Finding this requires digging deep into patent filings, which takes too much time for a quick news segment. Declining CapEx intensity projected post-2027. You have to actually read the footnote timelines on facility closures to catch this. Share buyback optionality sitting below intrinsic liquidation value. Nuanced capital allocation strategies are way too dry for prime time. Insider retention of minority stakes in the new spin-off. Corporate structuring complexities usually scare off retail financial media.
They are aggressively deploying that massive capital into a deep pipeline with 14 ongoing pivotal clinical trials in oncology. A major standout is pumaticamig, an investigational bispecific antibody. In a phase 2 trial for lung cancer, it showed a highly encouraging 62.5% response rate. Add to that their antibody-drug conjugates, which act like guided missiles delivering chemo directly to tumors, and you can see they are dead serious about becoming a cancer powerhouse.
Section 3. Trimming the fat. To support this massive R&D spend, management is making some very tough operational sacrifices. Here is the clear trade-off translated from their recent filings. They are bearing a heavy human and operational cost, planning to cut approximately 1,860 jobs. But by doing this, they project a return of roughly 500 million euros in recurring annual savings by 2029. This is a brutal but strategic redeployment of capital from excess manufacturing capacity straight into that oncology pipeline.
Let's map out exactly when these cost-cutting measures will actually hit the books. By the first quarter of 2027, they plan to conclude operations at their Singapore site. By the end of 2027, they will exit multiple manufacturing sites across Germany. And finally, by 2029, the full realization of those 500 million euro annual savings will be firmly integrated into their balance sheet.
Section 4. Leadership and spin-offs. Now, the fate of the company's legendary co-founders is fascinating. Instead of just stepping down, they are spinning out a brand new, independent biotechnology company strictly dedicated to early-stage mRNA innovations. BioNTech retains a minority stake, which essentially ring-fences that highly disruptive, cash-burning R&D away from BioNTech's new commercial focus. Here's how this corporate handover plays out. Binding agreements for the spin-out were targeted for the first half of 2026. By late 2026, the founders transition to their new venture. And by February 2027, Guido Oelkers takes over as BioNTech's new CEO. This is textbook corporate evolution, transitioning from a research-focused, founder-led organization to a mature biopharmaceutical company helmed by a commercially focused executive.
Section 5. The Valuation Paradox. Grab your calculators, because this is where the rubber meets the road.
Let me paint a very weird picture for you. Despite the fact that we just saw COVID revenues plummet nearly 60% in Q2, BioNTech stock recently spiked 22% in a single trading day. So what on earth caused a massive jump like that while baseline fundamentals are shrinking?
It was what the market calls a sympathy rally. That 22% spike wasn't even based on BioNTech's own clinical data. It happened because rivals Moderna and Merck reported highly successful phase 3 data for their personalized melanoma vaccine. This validated the underlying mechanism of mRNA cancer vaccines. Investors aggressively bought into BioNTech on the pure assumption that if Moderna's tech works for cancer, BioNTech's will too.
So there is a massive divide right now on how to value this company, which means it is time for the ultimate valuation gauntlet. I ran BioNTech through all 21 core equity models to find the truth. Let's break it down. Group A, cash flow and discounted. Standard DCF, 85 share assuming a sharp near-term revenue drop but steady terminal pipeline growth. UFCF, unlevered FCF, 82 share, excluding their minimal debt to reflect pure operating cash. FCF, 88 share, comparing to enterprise value, which highlights their massive cash cushion. FCFE, 90 share, showing equity value is heavily skewed by the cash pile. APV, 86 share, base case plus minimal tax shield since they carry almost zero debt. Group B, dividend and income. DDM, GGM, and multi-stage DDM all yield 0 share because they don't pay a dividend. However, the RIM, residual income model, gives us 105 share because book value is heavily propped up by that 16 billion euros in cash. EVA, economic value added, 95 share. Operating profit is shrinking, but the capital charge is incredibly low. Group C, comparables and multiples. CCA, sector peers, 115 share. Biotech peers trade at high multiples purely on pipeline hopes. PTA, precedent transactions, 130 share. Historical acquisitions in oncology fetch massive premiums. PE, trailing and forward, 75 share. Trailing looks cheap, but forward earnings are highly unstable. PB, sector average, 110 share, trading relatively close to its massive book value. EVEI BTDA implies 80 share, and EV sales implies 85 share. Group D, balance sheet and asset-based. Book value is roughly 100 share due to the massive equity base. NAV, net asset value, 95 share. Liquidation value, 80 share. Even in a fire sale, the cash acts as a hard floor. Replacement cost, 110 share, if you tried to rebuild their global mRNA infrastructure today. Group E, advanced options valuation, 140 share. Applying Black-Scholes logic to the massive optionality in their 14 oncology trials gives us the highest bull case number. Now, time for the legendary investor's reality check. Would the greats buy this today? Ben Graham, he would calculate his Graham number and see it trading near net current asset value. He'd love the balance sheet safety, but he'd run away from the forward earnings instability. Pass. Peter Lynch, we calculate the PEG ratio and it's essentially broken because current earnings growth is negative. Lynch's fair value formula fails here. Pass. Warren Buffett, he analyzes owner's earnings, which are currently dropping. Consistent ROIC is falling well below his 15% threshold. He'd say the moat is narrowing. Pass.
So let's synthesize all of this into a final verdict. Paragraph 1. Valuation. Based on the average of all 21 models in our gauntlet, BioNTech is currently fairly valued, right around that $90 to $95 mark. However, it is an incredibly polarized valuation, caught between a hard $80 liquidation cash floor and a $140 real options lottery ticket on cancer cures. Paragraph 2. Economic moat. Looking at Morningstar's 5 sources, BioNTech's moat relies entirely on intangible assets, specifically their mRNA patents and clinical data. Right now, that moat is actively shrinking as COVID revenues vanish. However, if even one of their Phase 3 oncology trials hits over the next 3 years, that moat will rapidly expand into a dominant cost and scale advantage in oncology. Paragraph 3. The verdict. The quantitative models are pointing toward a fairly valued stock propped up by cash, but the hidden flags suggest a lot of turbulence before we see profitability again. The company is fundamentally sound, but the stock requires immense patience. As BioNTech transitions from pandemic savior to oncology pioneer, is the market accurately pricing in a future cure, or are investors just chasing a mirage fueled by a competitor's success? The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework. Thanks for watching, and I'll see you in the next explainer.